Um, Imagine you open a brand new business.
Right. Like opening day.
Exactly,
Yeah.
opening day. You unlock the front doors, and there's just this huge line of eager customers wrapping entirely around the block.
Which, I mean, in almost any industry on earth, you'd be popping champagne.
Oh, absolutely. That is the ultimate dream. But if you are an insurance company,
Yeah.
that line is your absolute worst nightmare. Like, a line out the door means you are probably already bleeding money.
It really is the ultimate paradox of the industry. Because in a normal business, you create a product, you market it to your ideal demographic, and you try to pull them in.
Right, you pick the customer.
Exactly. But in insurance, if you aren't careful, the dynamic flips entirely upside down. The customer, and specifically the riskiest, most costly customer imaginable, is actively hunting you down.
Wow. Well, welcome to another deep dive. Today, we have something tailored specifically for the insurance study companion.
Yes, a really crucial topic today.
Yeah, so whether you are a CPCU student staring down an impending exam, or an insurance professional looking to sharpen your fundamentals, or honestly, just a curious beginner wondering why your premiums are priced the way they are, we are unpacking one of the most critical principles in the entire financial world.
We really are. We're looking at a force that dictates almost every single operational decision an insurance company makes. I mean, it influences marketing, pricing, product design.
Corporate strategy.
Yeah, all of it. It is sort of the invisible gravity pulling at the entire industry.
Okay, let's unpack this. Our mission today is to uh, demystify this force, understand why it forces insurers to act the way they do, and figure out how to absolutely ace those CPCU exam questions about it.
Right.
We were talking about adverse selection.
Adverse selection. And at its core, the phenomenon is actually really straightforward, even if the ripple effects are incredibly complex.
Okay, give us the simple version first.
So adverse selection is basically the tendency for individuals with a higher risk of loss to be far more likely to buy insurance or, to buy significantly higher amounts of coverage than individuals with a lower risk of loss.
Okay, so in everyday terms, the people who are the absolute most likely to suffer a catastrophic expensive loss are the ones knocking down the door, most eager to buy the policy.
Exactly.
Meanwhile, the low-risk people, like the ones who are exceptionally safe, healthy, and cautious, they look at the insurance product and think, I probably don't even need this.
Right. The easiest way to conceptualize it is that the individuals most prone to loss simply want the insurance the most.
Makes sense.
And the root of this entire dynamic is something economists call information asymmetry.
Meaning, one side of the transaction knows something the other side doesn't.
Precisely. When a person applies for a policy, they fundamentally know more about their own true risk level than the insurance company does.
Right, like, if you feel a strange ache in your chest.
Yeah, or, if you secretly drive a little too fast on the highway when no one is looking.
Right.
The insurance company, well, at least initially, they only see the paperwork, so they are operating at a massive information disadvantage.
I want to dig into that word adverse for a moment, actually. Because in standard conversation, we use adverse to mean bad or harmful or unfavorable, like having an adverse reaction to a medication.
Sure.
So why is this specific selection process called adverse?
Well, it really comes down to the alignment of interests. Think about an insurance company's absolute dream demographic.
Okay.
If an actuary could, wave a magic wand and create the perfect insurance pool, it would be filled with young, perfectly healthy people.
Right. They'd want incredibly safe drivers who never speed and homeowners with brand new roofs in areas with zero natural disasters.
Exactly. Basically, a massive pool of people who reliably pay their premiums every single month, but rarely, if ever, actually have an accident or file a claim.
Which is great for business.
It is the mathematical ideal. The fundamental business model of insurance relies on the premiums of the many paying for the losses of the few.
Right.
But because of that information asymmetry we talked about, reality operates differently. It is not the insurance company getting to handpick its ideal low-risk customers.
Right. The highest risk customers are actively selecting the insurance company.
Exactly. And that's why it's adverse. It's inherently unfavorable for the insurer. The selection process naturally tilts the scales against their profitability from day one.
You have a structural disadvantage right out of the gate.
Yeah.
It's like opening an all-you-can-eat buffet, and the only people who show up on opening day are professional competitive eaters who have been fasting for a week.
That captures the financial dread perfectly, yeah. If you price your buffet for the average eater, but only the professionals show up,
You go bankrupt.
you go completely bankrupt. So to make this concrete, Let's explore a very specific real-world scenario.
Okay, let's do it.
Let's look at how this dynamic spirals completely out of control if it's left unchecked, particularly in something like health insurance.
All right, let's set the stage here. Imagine an insurance company is rolling out a brand new health insurance policy.
Yeah.
And to keep the math clean, let's say they have two potential customers looking at this policy.
Okay.
Customer A is a healthy 25-year-old. Based on general statistics, this 25-year-old is expected to incur about $500 in medical costs for the entire year. Maybe a standard checkup, a flu shot, maybe a minor prescription.
Right, low cost. Then we have customer B, and this is a 60-year-old individual who has some pre-existing conditions, let's say diabetes and hypertension.
Okay.
Based on their health profile and history, their expected medical costs for the upcoming year are going to be around $8,000 for regular specialist visits and daily medications.
So you have a $500 expected cost and an $8,000 expected cost. Now let's assume this insurance company decides to be incredibly egalitarian. Yeah, they decide to ignore risk classification entirely. They announce to the public, we're going to charge a uniform flat premium to absolutely everybody.
Right.
Everyone pays $2,000 for the year, regardless of your health.
Well, by setting a flat rate, they are walking directly into the trap of adverse selection. The behavioral economics take over immediately.
Yeah, let's play this out from the perspective of those two demographics, looking at that $2,000 price tag.
Okay.
As the healthy 25-year-old, I'm looking at my personal budget. I historically spend about $500 a year on doctors. And you are asking me to pay $2,000 for coverage.
The math doesn't work.
It makes zero financial sense. I am taking a guaranteed $1,500 loss just to hold the policy, so I am going to pass. I'll take my chances out of pocket.
Exactly. The low-risk individual voluntarily exits the insurance pool because the cost-benefit analysis just doesn't justify the expense.
Right. Now, switch to the 60-year-old with diabetes and hypertension. I know for a fact I'm going to spend roughly $8,000 this year just to maintain my health.
And you're being offered a flat fee of $2,000.
This is the financial deal of the century. I am buying this policy immediately, and honestly, I am texting every single person in my support group to go buy it too.
And there it is. The high-risk individual floods into the pool. And this is where the mechanics of insurance break down completely.
Right.
We mentioned earlier that insurance relies on the law of large numbers, the premiums of the many paying for the losses of the few. But because the low-risk people opted out and the high-risk people rushed in, the pool is entirely skewed.
So the company is collecting $2,000 per person, but they're paying out $8,000 per person.
Right. They are bleeding money at an unsustainable rate.
Because if the claims coming in are disproportionately higher than the premiums collected, I mean, the company has to take emergency action just to survive.
Yeah, their only real recourse is to raise the price of the premium for the following year.
And this is where we enter what the industry ominously calls the death spiral.
Yes, the death spiral. Let's say the company looks at their massive losses and realizes they need to double the premium just to stay afloat. So the flat rate goes from $2,000 to $4,000.
Oh, I see the chain reaction here. When the premium jumps to $4,000, the people left in the pool reevaluate.
Exactly.
Maybe there was a group of people who had about, say, $3,000 in expected medical costs. When the premium was $2,000, it was a good deal for them, so they stuck around.
Right.
But now that the premium is $4,000, it's a bad deal for them too, so they leave. Raising the premiums just pushes the next tier of relatively low-risk people out the door.
Which concentrates the risk even further. The pool is now even smaller, and it's comprised of even sicker, higher-risk individuals.
Wow.
So the average expected cost per person skyrockets again. The company is forced to raise premiums to, say, $6,000, which drives away the next tier of people.
This cascading effect, higher premiums causing lower-risk individuals to drop coverage, resulting in even higher average costs. That is the pure destructive machinery of adverse selection.
It is. Eventually, the product collapses entirely because it becomes completely unaffordable for anyone.
And, you know, this doesn't just apply to health insurance either. You see the exact same psychological trap in property insurance.
Oh, absolutely.
If you offer a flat rate for flood insurance nationwide, the homeowner in the Nevada desert is going to opt out immediately.
Right, they don't need it.
But the homeowner whose back porch sits 10 feet from the Florida coastline, they're going to buy double coverage. The pool immediately fills with guaranteed losses.
It applies to auto insurance, life insurance, professional liability. I mean, the fundamental human behavior remains constant across every single line of business.
The people most exposed to danger are the most desperate for a financial safety net.
Exactly.
So if this cycle is so deeply ingrained in human nature and it naturally pushes low-risk people away while pulling high-risk people in until the system collapses, how does an insurance company actually fight back against that gravity?
Well, they fight back using the industry's ultimate defense mechanism, underwriting. Adverse selection is really the foundational reason why the underwriting profession even exists. Without a gatekeeper to evaluate the incoming risk, the death spiral is inevitable.
I actually want to clarify the true function of that gatekeeper for a second, because there is a very common assumption among the general public.
Oh, for sure.
A lot of people view underwriting as just like a fancy corporate term for the rejection department. They think the underwriter's sole job is to hunt for technicalities to deny people coverage.
It is a pervasive misconception, but it completely misses the economic reality of the business.
Right, because they want to sell policies.
Exactly.
Yeah.
An insurance company fundamentally wants to sell policies. Collecting premiums is how they generate revenue. So the goal of underwriting is not to arbitrarily reject clients.
Okay, so what is it?
The true purpose is to keep the total accumulated risk within a manageable, mathematically sound range for the company. It is an exercise in risk calibration.
So they have to close that information asymmetry gap we talked about earlier.
Right.
They have to figure out exactly how much of a competitive eater you are before they let you into the buffet.
That's a great way to put it. And they do that through rigorous data collection. They evaluate a multitude of factors depending on the type of insurance.
Right.
For life insurance, they require blood tests, medical histories, and family questionnaires. For auto insurance, they pull motor vehicle records to see your speeding tickets and check comprehensive loss databases to see your past claims.
And for homeowners insurance, they analyze the construction materials of the house, the distance to the nearest fire hydrant, the local crime rates.
Exactly. And once they gather all of this data, the underwriter essentially has 3 distinct levers they can pull to calibrate that risk.
Okay, what's the first one?
Step 1 is the most fundamental, the accept or decline decision. They have to determine if the risk is just so severe that it falls entirely outside the company's guidelines.
Right, like if a person has 6 DUIs on their record, a standard auto insurer will simply decline the risk.
Yeah, they just won't touch it. But if the applicant falls within acceptable parameters, they move to the second lever, which is determining the premium.
And this is where they actually fix the problem that caused the death spiral in the first place.
Precisely.
Instead of charging everyone that flat $2,000 fee, they use risk classification to put people into different buckets. The safe driver pays $500, and the aggressive driver pays $2,500.
Right. The price finally matches the reality of the risk.
Okay, and what's the third lever?
The third lever involves applying restrictions. Sometimes an underwriter will accept a risk, but only on specific terms.
Like what?
Well, they might insure a property, but add an exclusion for windstorm damage because the house is located in a high-risk hurricane zone. Or they might issue a health policy but attach a waiting period for certain elective surgeries.
You know, if you are sitting for the CPCU exam or any major insurance licensing test, they love to test this exact dynamic.
Oh, they test it constantly.
They will try to trick you by asking for the primary purpose of underwriting. Your instinct might be to say, like, to price policies accurately or to reject bad risks. Don't fall for the bait.
Right. The golden answer you absolutely must lock in is to reduce adverse selection. That is the foundational purpose.
Good to know.
The exam might also approach it from a slightly different angle, asking why insurers classify risks into different categories. And the answer remains intertwined. To charge premiums that accurately reflect the expected level of risk and thereby reduce adverse selection.
It really is the shield the company uses to protect the integrity of the pool.
It is.
So if underwriting acts as a highly effective bouncer at the front door of the club, checking IDs and turning away the absolute highest risks, the insurance pool is totally safe, right?
Well, not exactly. Getting a low-risk person through the door exposes the insurer to an entirely different psychological trap.
Oh boy.
Yeah. And this brings us to a massive pitfall for students studying this material. The line between adverse selection and another major insurance concept called moral hazard.
Moral hazard.
Right. They both deal with an increase in risk, and they often get tangled together in people's minds, but they're fundamentally different mechanisms driven by different psychological triggers.
Here's where it gets really interesting. The ultimate differentiator between these two concepts is timing.
Timing is everything here.
It is entirely about when the risk-increasing behavior actually occurs in relation to the signing of the contract.
Timing is the key to untangling them. So adverse selection happens before the policy is purchased.
Right.
It is a built-in characteristic or an existing intent of the person seeking the insurance. The person with a crumbling roof is highly motivated to buy homeowners insurance today. The risk exists independently prior to the contract.
Got it. Moral hazard, on the other hand, happens after the policy is purchased. It is a behavioral shift caused by the very fact that the financial safety net now exists.
Exactly. Let's say a driver buys a brand new car. Before they have insurance, they are incredibly protective of it.
Oh, yeah. They park it inside a garage, they check the locks twice, they install a steering wheel lock.
But after they purchase a comprehensive auto policy, their mindset shifts. They suddenly start leaving the car parked on the street with the doors unlocked and the keys in the cup holder.
Wow.
They rationalize it by thinking, well, if it gets stolen, the insurance company will just write me a check for a new one.
Okay, let's go back to our nightclub analogy for a second. Adverse selection is about who is trying to get into the club. It's the phenomenon where the biggest troublemakers in town, people who love starting fights, are the ones lining up at the front door, eager to get inside.
Right.
And the bouncer, the underwriter, has to spot them and turn them away, or charge them a massive cover fee.
That is a very fitting parallel.
But moral hazard is about how people behave after they are already safely inside the club. A patron might have been perfectly polite and quiet out on the sidewalk. But once they are inside, knowing the bouncers or the insurance company will handle any mess they make, they start acting recklessly.
Yeah.
Start knocking over tables and breaking glasses because they know they won't be the ones sweeping up the glass at the end of the night.
Exactly. The presence of the protection inherently changes the behavior. And because adverse selection and moral hazard are two completely different diseases, the insurance industry has to deploy entirely different cures for them.
Okay.
We established that underwriting is the cure for adverse selection at the front door, but underwriting cannot cure moral hazard. An underwriter evaluating your application today cannot physically stop you from leaving your car unlocked 6 months from now.
Right. So how do they stop people from breaking glasses inside the club? I mean, they have to make sure the patron still feels some of the pain if things go wrong.
Yes. They ensure the policyholder maintains skin in the game.
Skin in the game.
To control moral hazard, insurers use structural policy mechanisms, specifically deductibles and coinsurance.
Okay, so deductible means you pay the first chunk of the loss before the insurance kicks in, and coinsurance means you split a percentage of the bill with the insurer.
Right. By requiring a $1,000 deductible on that auto policy, the insurance company ensures the driver still suffers a painful financial penalty if the car is stolen.
Oh, I see. Even if the insurer covers $30,000 for the replacement vehicle, losing $1,000 out of pocket is enough to motivate the driver to keep locking their doors.
Exactly. It creates a psychological anchor that aligns the customer's interests with the insurer's interests.
Because they both want to avoid the loss.
Right. And that distinction is so critical, especially for exam prep. Adverse selection is pre-purchase pool contamination, and it is fought with underwriting and risk classification.
And moral hazard is post-purchase behavioral change, and it is fought with deductibles and coinsurance.
Yes. If you can keep that timeline clear before the signature versus after the signature, you will not fall for the trap questions.
So what does this all mean when we pull it together? If you were summarizing this for a study guide, the core takeaway is the causal chain. High risks are naturally drawn to insurance. To prevent a death spiral of rising premiums, insurers must use underwriting to classify those risks.
I love how our source material actually provides a memory rhyme used by students to lock this exact chain in.
Oh, really?
Yeah, translated into English, it essentially goes, high risk seeks insurance, underwriting acts as the gatekeeper, risk classification sets the premium, and that keeps the business safe.
I like that. It perfectly traces the life cycle of the problem and the solution.
It does. But before we wrap up, I think there is a broader implication here worth pondering. Everything we have discussed today regarding adverse selection relies entirely on that initial concept of information asymmetry.
Right.
It assumes you can hide your true risk from the underwriter.
But I mean, the world is changing rapidly. That information gap is closing.
Oh, dramatically.
Right.
We are entering an era of unprecedented data collection. We have wearable health monitors tracking our heart rates, sleep cycles, and blood sugar in real time.
Yeah, and we have telematics devices in our cars, recording every time we brake too hard or accelerate too fast. Smart home sensors monitor our plumbing for microscopic leaks.
Exactly. So if the insurer eventually has access to all of that real-time data, you can't hide your risk anymore. The underwriter will know exactly how much of a competitive eater you are before you even approach the buffet.
Wow.
Which leads to a fascinating and, frankly, somewhat daunting question. If information asymmetry disappears entirely, does adverse selection cease to exist as a problem for insurers?
That's a good question.
And if insurers can perfectly predict and price everyone's exact risk, what happens to the people whose real-time data proves they are simply too risky to insure at any price?
Oh, wow.
Yeah, a perfectly efficient market might not leave a safety net for everyone.
That is a really heavy, provocative thought to leave you with. As the technology evolves, the fundamental principles of insurance might have to evolve right alongside it. We will leave you to ponder how you feel about your smartwatch sharing data with your underwriter. Thanks for joining us on this deep dive, and we'll catch you next time.